Welcome to Momentum Monday. Today is January 16th, 2022. Howard, I see you've been doing laundry in the background. What's going on with that?
It's Rachel's home, so that is her mess. This is her room, which has become, when she's not here, my room.
Your office.
That is correct. How you feeling this week?
I feel pretty good.
You feel pretty good, huh?
Yeah, it hasn't been that bad. All right, let's go back to the markets. I mean, I think from my perspective, the indices are in correction mode. Like they're making lower highs. The Nasdaq 100 tried to rally early in the week, was rejected below its declining 20-day. So it's kind of holding on a thin thread here. The S&P 500 holding somewhat better, mostly thanks to oil and gas, industrials, and financials in some part. Small caps looking the worst, testing their the lows of the really long range here near 208. So if that level is lost, we might see some acceleration of selling. Probably the good news is that earnings season starts this week, and for the next 4 weeks, the market will pay more attention to earnings and not so much to the to the macro aspect, to the increase in interest rates. So that's about it. In terms of relative strength, anything outside of the basic material space, I would highlight semiconductors, definitely the strongest sector in tech, the strongest group in tech.
Semis still look great, which, the economy's healthy.
Yeah, absolutely. I mean, the market is always looking 6 months ahead. So maybe the market is either seeing something or just in case discounting something that might happen, but it might not. And we'll definitely be seeing that rotation from growth into value in the past few weeks, but also in the past year as well. If you take a look at many of the like high momentum, high growth stocks, like we're talking bio, some of them don't even have earnings, but let's call them high risk, high beta stocks, like biotech, internet retail, software. Those three groups have been the worst hit, and many of them are down 50% or more for the past 2 months.
But they should be, right? Interest rates are going up and you don't have earnings. Like I look at Virgin Galactic, like anything, when you enter a rising interest rate environment, I'm forgetting space because that was just a bad deal from the get-go. It could probably be a zero. But, anything frontier, space, stuff that's not needed.
IPO, the ETF, it's a good representative or the ARKs.
Yeah. So it's a good idea. So stuff that hasn't proven itself yet. People in a higher interest rate environment, it's all coming off relatively low numbers. Like we just refinanced still well under 2.5%. So in our own fear of just locking stuff in, it's silly not to just redo stuff for 10 years and lock in stuff. So people should be doing what they can do to save real money here. If you really are concerned about rising interest rates, even if you're not, locking in stuff again at 2.5% is insane not to, because your mortgage is your biggest asset for most people. As it relates to stocks, not all of us are going to now become experts. All the epidemiologists are now oil experts and basic material experts and financial experts. I doubt it. Now, for swing traders and traders, sure. But I think you pulled up the charts that matter. The semiconductors, I said it last week, the X's over the Q's, right? XLF and XLE. I'm going to share my screen. I'm going to kind of just make it easier for you. So hang on, tell me when you can see my screen.
Okay, we can see it. Yeah.
Yeah. All right. So this is Koifin. Everybody should have it. This is your home screen. You can set it up any way you want. But here's the last 10 years. You see the NASDAQ up 600%. Okay. Tech obviously is in charge. That's why I've always said QQQ's over SPY. But now things are changing. Rates are going up. And as you saw from the IPO index that Ivan showed, when rates go up, stuff without unproven things, even in tech. Hang on, shoot, sorry. Let me just, I'll get better at driving, but I want to show people this. Things with unproven cash flows, people dump. And that's what institutions do. You know, they get paid, they got to show their LPs and their investors that they're not stupid. And so they're as guilty as their regular retail person. The idea is to get in front of this, okay? And a lot of growth people, you know, have just been drunk that this will always happen. So you can just see the inklings of a rollover. And then I've brought in the blue charts at the end, the EEM and the energy, to show you like how bad it's been for, you know, I'm not going to pull up the full commodity index, which is going up as well, because gold's been a dog too, but you can just see how bad it's been for the rest of the world versus US. The emerging markets, a mess for the last 10 years, averaging 5% a year. And energy just finally swinging positive. And remember, in March 2020, energy went negative. So you can see the gaps, okay? So a lot of institutional money will start trying to play the gaps, especially if they think interest rates are going to stay higher and that inflation persists, because the Fed is kind of caught here, right? And they've been pretty clear that things are going to change. So that's kind of the environment. And you can't, it doesn't mean you have to go buy energy stocks, but there's nothing against having a higher cash level until growth kind of proves itself again. And so you can easily flip through some of this stuff. The other thing is stock tips 25, which I share every week. I mean, do you really want to be in Schlumberger, Halliburton? Because you can go buy these leading energy stocks. They've had a great run, but they're just kind of breaking out. No, they're not. Like, so these things are still in very long-term downtrends, but these are what's working right now and gapping higher.
Yeah, most oil stocks are up 20% year to date. So
yeah, so that's what's working. You know, so you can scan this free email once a week, and you can kind of see that. I mean, Wells Fargo, we saved them. It's a criminal organization. You know, whoever they're. But do we want to own Wells Fargo for the long term? You know, maybe in a rising interest rate environment, they can go buy a neobank and modernize themselves, because they have, what's their market cap? They have a 225 billion market cap. I'm not saying management's going to get smart, but there's a case to be said that, like, of the 100 neobanks from Chime on down, that are even Chime, which is supposedly 10 to 15 billion dollars. What does that cost for Wells Fargo to just 10%, 5% of their company to go become Chime and keep their whole back-end business? So there is a case. You know, you can't stick your head in the sand, and here's the XLF. The market caps of these behemoths that we saved in 08 can go do some damage in the IPO market and buy some broken IPO. So that's the first thing. The overall thing that I see, Ivan, is that, you know, VIX a little bit elevated at 20, but not hugely elevated. The markets are kind of acting normal, considering that you know, we're in this kind of period where we've got inflation that hasn't been factored in 40 years, and higher interest rates. So I think unless you want to kind of move where the puck is going and start trading energy stocks and commodity stocks, it's going to be very tough in growth world. And it's just been, what, 5 years of Momentum Mondays where every dip could be bought in growth. But there's some fundamental differences now with rates going up and inflation and, you know, levels not seen in 40, 50 years. Does that make sense to you?
It makes sense, but if you're an active trader, you need to adopt some.
Yeah, I mean, this is for both. You know, for me, I can't adopt. I don't have the time. And that's why I started saying a few months ago, that indexes are probably a better place to be, because at least the indexes, they may be weighted high to tech right now, but over time, the indexes at least give you the exposure to these other sectors.
Yeah.
And so, if you don't have the time, now would be a great time to think about, selling some of your losers and, figuring out how you want to index a little bit. Or like Ivan can do, is just go, a ticker's a ticker and a price action's a price action, and, go start trading Wells Fargo and some of the energy stocks, I guess.
Yeah, exactly. I mean, you can just short the ones that are in downtrends.
Yeah.
I mean, software stocks have done so.
I will defer back to you. Let me get rid of the screen.
Okay, let me see.
I'll stop screen
sharing. I'll stop it, and then I'll take over. Let's see. Share. Okay, so now you see my screen, right?
Yep.
Okay. So software and tech in general has done so well for the past 5 to 10 years, and so many people just are in love with their long-term performance that I have a feeling that many people don't have an exit strategy.
Right.
And yes, occasionally you're going to catch Amazon and Apple or Google where every dip is buyable and they'll continue to go higher. But in 8 out of 10 cases, you're not going to catch Amazon. You're going to catch, something like Virgin Galactic, where it will go up 1,000, 3,000%, and then it will give back 50% to 90% of its gain. So that's why I'm always saying, hold them, follow trends, but have an exit strategy, because not all of those stocks are going to make it in the long term. So it would be.
No, I remember, pull up Cloudflare, for example, great company. I remember selling it on the way up at 100, 120, 160, 200. A lot of people were like, you're crazy. I mean, why would I pay the taxes? And one of my friends who were, had 10 baggers, now have 5 baggers or 4 baggers, but now they're thinking of selling and paying the tax now. I really think, doing things for tax reasons, if you're investing, unless you're running the company and have like inside information and not like illegal, unless you are running the company, not selling something because of taxes.
Yeah.
On the downway or upway is a terrible idea. You have to. And so now a lot of people are caught in companies like Cloudflare. I look at DigitalOcean, which is a company I started buying back because I was selling at 100, on the way up. Here's a stock could be back in the 40s or 50s. I mean, long-term growth is great, but if interest rates forces these things to be repriced, these are expensive stocks and can surprise you to the downside. The growth isn't going away. The cloud is not going away. The margins are not going away, but you're seeing an incredible repricing of these assets. And at the same time, if commodity prices are going higher, these energy companies have so much leverage. Again, I don't understand them and I don't trade them, but they have incredible leverage, and they're all been in, reducing capacity for 10 years. So if people, and remember, we've been closed, the country's been half closed for 2 years. So if April the market reopens and everybody's going back to work, imagine the shortages that we'll have then if everybody's traveling and
the market is kind of discounting that. I mean, as we say, it's always tries to look 6 months ahead. But back to your comments on not selling for tax reasons, I actually hear absolutely the same thing from several people. I mean, we don't want to sell because we don't want to pay taxes. And it seems like every new generation of investors kind of repeat the same mistakes. I think taxes, not selling for tax reasons, I think it's a stupid reason, especially if you're trading individual stocks, because especially momentum stocks, because many of them are gonna have substantial corrections, 50% or more, and they might not come back. I mean, an index, that's a different thing, because an index like the S&P, they rebalance them once a year, so they basically
again why
do the pruning for you.
Okay, well, I think, listen, I don't love this market because it's not for me, but you can see, Ivan's easy to follow Ivan. And you can see, wow, some of these charts look fantastic. What do the monthlies look like on these?
The monthly are not that beautiful, but
Yeah.
weekly and daily they are. And the other sector, other than semis and outside of basic materials, all the car manufacturers have done really well. And we're talking like legacy car makers like Toyota and
Yeah.
Ford and Honda and BMW.
Yeah.
All of them are kind of trying to catch up. Obviously, Tesla is the big leader, and we're also seeing the Chinese one, XPV, kind of holding well, building new base,
Yeah.
AI. So the car manufacturing definitely a hot space alongside semis and TSM, as I said, reported earnings, beat estimates, gap to all-time highs basically on Wednesday or Thursday. And they said that the biggest growth they saw was demand from car makers, like 10% growth. So definitely those are two hot spaces in tech right now, other than the basic materials.
Yep. And as always has happened in semiconductors, and I got this wrong, was everybody builds up capacity, much like oil, the unwinding of capacity, and then everybody's left holding the bag. That cycle has been much better, maybe the best ever in semis, which is, fooled people like me.
Yeah, the semiconductor equipment stocks, especially that group, extremely strong, near all-time highs, all of them.
Yeah.
So some of them starting to break out. So
yeah. So I don't know. It's a really interesting moment in the market. If interest rates reverse here, growth will definitely kick it back in, and energy will crumble. But it doesn't look that way. It looks like the Fed's kind of stuck.
Anything is possible. Like I would be really, really surprised if interest rates really have a significant acceleration from here. But it's possible, but I don't think it would happen.
That's why I started buying a few of these, down 50% software stocks. So we'll see. Definitely not something I want to do full time. All right, buddy. Have a great week.
All right, you too, Howard.
Glad you're feeling better. Have a good week, everybody.